Welcome back to the Pulver Report. It is just after 9 o'clock on July 1st. We're officially kicking off Q3 with a holiday week. Thursday is 4th of July. Markets will be closed, but we have FOMC minutes on Wednesday, non-farm payroll on Friday. A couple news events that might get the market moving a little bit, whether we like it or not. So we're going to have a look at that today. Let me double check my audio. Aha.
Let's try this. Okay. See if we can switch up the audio a little bit. All right. Good morning, everybody. Nice to be here. We are live on YouTube, live on Facebook, live on LinkedIn, live on Twitter /X. Let's get started. Here is last week. Here are several weeks. In shaded red was last week's finish. We had a red candle for the week, mainly because of Friday. Friday was end of month. Friday was end of quarter. Pretty good volatility. We tapped the all-time highs once again at 550 and change and faded all the way back down here to 543. So about a $7 move last week from high to low on Friday after a very quiet Monday through Thursday. This week, like I said, holiday disruption on Thursday, but some pretty decent news that may get the markets moving a little bit. I still think a reasonable move would be resistance, and the CPI gap looks all the more appealing for a pullback. Let's go to the SPX right here. On the daily time frame, overbought conditions with divergence, tapping equal highs from last week. I could see this week's trading being very tight. And if we break below the recent lows, which would be around 540, see where these lows are at, just around the 54.50 on the SPY, or I'm sorry, 54.50 on the SPX. And we would have to break, let me move this chart line up just a little bit, around 542, put 542.50 on the SPY. So if we break 54.50 or 542.50, watching these levels really closely, 553 at 550 at 30. Okay, so I'm going to surround top and bottom on the SPY. Interesting statistics. Last week we did in fact poke the high, which markets typically test the highs around 65% of the time. That proved to be another week. What's also interesting is if we at least hit the high from last week, there's only about a 12% chance that we hit both high and low. And you can see here, it did not touch last week's low. So some just fantastic probabilities in just the market. That was a nice little pull from one of the studies at Edgeful. And I talk about that quite a bit. I've posted some videos on my YouTube channel about it. Go check those out just to see how the dashboard works, finding some of those really insightful probabilities and tradable actions on, look, if you want to trade with a 65, 71, 75% probability, know what to look for, right? Certain stocks, certain ETFs, futures, Forex, weekly levels, daily levels, certain range breakouts. Really, really good stuff. So I have 2 videos posted on my YouTube channel, and you'll see me talk about this pretty regularly through my trading rooms as well. Okay, so watching this week, we are up around $1 pre-market from last week's close. We'll take a look at the futures market as well, watching the high, watching the low from last week, watching the high, watching the low from the week before. So this low, this high, this low, this high. It would be, if we get a break, I'm looking for the CPI level to be filled. Okay. If we have another, since it's a holiday week and it could be a short kickoff to Q3 with holiday disruption on Thursday, we could see the market being somewhat quiet once again, maybe. So I will continue to track and monitor some 0 DTE on the SPX. I'm also looking, where could we fall? We fill the CPI gap here around 537. I do have a trade. Let me find out where this one is. It's not what I wanted. I'm looking for my equities on demand. Make sure this is the right link. Yep. So we have a 726 expiration. The 544 is the long call. 542.50 is a long put. We paid about $11 for that. So if we fall into, let's say 537, that'd put me up $7. If we did that, this week, for example, then maybe there's enough extrinsic value or time left in that trade to get that thing profitable. I am curious, of course. I mean, if we hit 537, is that it? We hit 537 and then buy the dip, or are we going to see a little bit more push lower into, maybe this previous high around 525? So we'll find out. But I'm playing it both ways, going out for towards the rest of the month. I mean, the 26th or 28th of, no, sorry, 26th of July for that SPY trade, and then have also a trade out on NVIDIA to August 2nd. NVIDIA's been pretty quiet over the last couple of days. We had an aggressive sell-off, not last week, but the week before, and we're just sitting there with a bit of a correction from high to low, around 15 to 16%. Is NVIDIA going to be somewhat contained? Are we going to have a high, low, lower high, lower low? Well, if the SPY feels that CPI gap is going to put pressure on the broader market, is it led by something like a larger, mega cap tech sell-off like NVIDIA dropping to, let's say, 100, maybe 110? It's very possible. That's a $12.99 debit that I have running with a 126 put. So if we hit 110, we hit 100, hopefully that will allow some pretty good profit. I've got a $20 max profit in that position. And that's also out through the end of this month into the first week of August. Okay. Let's see here. Good morning, Angela. Giza, good morning. Chris, good morning. Ruth Ann, good morning. Benji says hi. Donna, good morning. David, good morning. Nice to see everybody. Nice to see everybody. All right. Let's take a look at the futures dashboard. Well, that seemed quick. Democratic Party's already turning on Biden. Totally understandable. Just more election drama, I guess, at this point. If the Democrats are going to quickly, vet and toss out a new candidate, we'll certainly see how that goes. Futures market this morning, steady, choppy, 0.13, 0.25, 0.31 to the upside. Gold slightly up, says flat, but we're going to take a look at gold and silver as well. Gold's been inching higher, 29.63, oil 82. Let's have a look at those prices. So dollar index. Also, did we have some French election stuff going on over the weekend? Was it this weekend? So dollar index, 3 days. I keep going back to these numbers, 105.60. We pulled right back to it again. This would be a spot where if we start to close lower, my long position on the dollar doesn't look nearly as good. I'm not in all dollar positions, but there's a couple of them. So anyway, we'll see how this translates. Perhaps we've made enough work over the last maybe week or so to breach this 105.60. Is it going to give us, I don't know, this is a tough freaking pattern, man. Are we doing something like that? Maybe, where, the bulls have pushed it in this level. We have some indecision. Okay. And then there's another move coming later. I really still I'm struggling for just a clear path on the dollar. It won't give us more than a couple of days of direction. It takes it all back, and I still like these levels a lot. I mean, 105.60, it just has to hold above it. It's pretty simple. But it's been frustrating to have such little follow through after you go from 103.90, right, 10400 to 106. I mean, there's a 200-point move in the dollar index, yet it barely translates into what I think is actionable trading in the forex market, dollar basket wise. So it's been tough, and I don't love it, but I just want to see how this plays out. I mean, if it continues to chop around here at 105.60, maybe the dollar looks a little bit better. We are seeing central banks starting to cut rates. The dollar, not yet, but the market's still anticipating a September rate cut. I read the play from both sides, whether they can cut rates, should cut rates, will cut rates. I mean, the market says yes. CME Fed Watch tool says yes, right? 60% probability in September the Fed cuts one cut, 25 basis points. Is that the little relief for the consumer? Maybe. Right? Why is it not rocked the U.S. economy yet that we've had higher rates for longer? It's really all boiled down to household equity. I took some interesting stats. Gentleman that I follow out there that does a great job with data and correlations is Charlie Bolello. And let me find out some of the screenshots. I listened to his session yesterday. So just some interesting stats here. Let's go. Okay. So we have tale of two markets, 2024 total returns as of June 27th. Large cap versus small cap spread. So you have your large caps up 15.7%. So SPY's roughly up, 15%. Small caps down for the year 1.7. So you have a 17+% spread between large cap, small cap, one of the largest on record. You have, or at least into the 90s. U.S. growth versus value, 15.1% spread. Growth is 21.4%, value 6.4%. SPY versus the international markets, 15.7 versus 5.5. Again, a spread of 10.2. Semiconductors versus regional banks. This is laughable. Semiconductors up 48% just this year. Regional banks down 7.7. If you're looking in the bond market, short duration 2.6%, long duration 8.3 to the downside. So your BIL versus ZROZ, crazy different. Dollar, the dollar's up 7.6, the Japanese yen's down 12.6, spread of 20%. So very different approach. If you're long on one, long on the other, clearly they're performing very differently. Japanese 10-year government bonds, tech sector versus the overall S&P, the ratio, again, tech sector is leading most of the way, as high as it's been since 2000. U.S. housing affordability sitting at these crazy lows. We haven't seen these lows since the 90s, yet the National Home Price Index continues to go higher. Year-over-year price sales are going down slightly. There's a softening there. One thing I thought was interesting is the money supply. If the U.S. money supply decreases, the average U.S. home price also decreases. If the money supply increases, U.S. home price increases. Interesting thought. You saw this maybe last month in the news. The Democrats are trying to push together some proposal to give like a $10,000 incentive to buy, which means prices are just going to go up by $10,000. There's no way that a seller's not going to enjoy that extra bonus if they're going to incentivize buyers. So again, it might be with all the right intentions, but all it's going to do is raise prices of houses. So anyway, crazy good stuff. Household debt. Most household debt is fixed, which is why the consumer's been pretty resilient. Right now, about 40% of U.S. mortgages are also mortgage-free, which I thought was impressive. About 96% of mortgages are fixed rates, not variable. And pretty much since COVID, everyone's been refinancing or buying homes where most of the rates are manageable at, sub 4% or sub 4.5%. So that's why the U.S. consumer is hanging in there. I noticed some pretty interesting highs in Royal Caribbean. Stock price continues to go up higher. We're at 160 on Royal Caribbean from COVID levels which I did. I did enjoy a nice participated move in Royal Caribbean. I wish it was more, but I was looking to get long here from high to low, pull back to 50%. So long around $24, $25, pulled back to around $80. That was an awesome run in Royal Caribbean over the couple of years, 2020, 2021. I was looking for, and I didn't miss it by that much, but we had a base here around $35. I was looking for a retest. I didn't get it. I tried to get long here at 25 again. Slippery thing never came back. But here we are, above previous highs, above pre-COVID levels into some new territory. Airlines, I thought, have been doing a pretty good job. These should be seen as cyclical, but if the consumer is spending this weekend, TSA might have a high record of like all-time screenings again. So all I'm saying is the consumer seems to be doing okay. The economy seems to be humming along to the tune of maybe 2 to 3% for the U.S. and steady, I guess. Um, doesn't mean that we're not overbought, a little bit overextended in the markets. I certainly think that I have the right technicals to see on the daily and weekly chart. We could see a pullback. I'm not looking for anything ridiculous. I don't know if the market's just going to all of a sudden, drop the floor and just crash. But I could see a, 3 to 5% correction should be healthy, similar to what we had in April. April was about a 6% sell off, 8% sell off in the Nasdaq. Let's go to the DIA. Talking about the DIA, what do we have here? How does the yen being so weak affect their economy? I mean, if anything, the weaker yen has been helping the Nikkei 225 get out of the hole that they're in, right? I mean, they've had a drawdown for 34 years. They finally breached all-time highs. It's been a heck of a decade plus coming back, and it's been a heck of a 3-decade journey to get back. So the weaker yen is helping. All right. The issue with that is, again, this is all happening with a very strong carry trade, where you're essentially borrowing yen to apply elsewhere, and that is just a classic case of carry. That's a classic case of arbitrage, and I don't see the yen or the BOJ necessarily changing. And what I thought was interesting is the Bank of Japan doesn't intervene at levels. They tend to intervene at price changes or rate of change. So let's go to the dollar yen for a second. Okay. Do not think for a second that 160 all of a sudden is the level. Okay. What they tend to intervene on is rate of change. Okay. This yen went from 146 to 160 for about a 9.4% move. Okay. Let's just make a mental note of that. 9.4%. Donna, that is really exciting as well, because I saw that last week I totally missed. Oops, let me go to this chart here. I totally missed that run that apparently Roaring Kitty had a little bit of a run on Chewy. So this thing screamed up here towards. We had a wick high at the 200 around $39. Pre-market we're up a little bit. So anyway, I mean, I will be watching. I do have Chewy covered at like 27.50. I'm going to look to see if I can roll that. I might as well see if I can roll it out and up, and still lower my cost basis. Try to roll it for a break even or better. Try to get a credit if I can. But I'll take a look at that this morning with my my Schwab account. Yep. So if I can roll this from 27.50 up to 29 or up to 30, give myself a little bit more on the bottom line. Look, I don't know if this is going to revisit $38, $39. I'd love for it to do that, and I'd like to take as much out of that as I can. Perhaps I go out another 2, 3, 4 months in duration, try to roll up my strikes as well. Like I said, I would take a small debit as long as I can roll my profit levels up by a couple of dollars. Or obviously, I try to roll it for a net credit and still try to roll it out and up. So out in time and up in price. But yeah, Chewy had some action last week. So we'll talk about that more in EOD. So I was going to go back here to the yen for a second. 9+% rip from this March to April high. So let's say that from this recent low, okay, from this recent low, or this recent low rather, I mean, if we get about a 9% move, where would that put us? Okay. If we get a 9% move, that puts us around 168. So because we didn't react here to 160 on the dollar yen, we didn't react really anywhere on the other yen crosses. Other pairs, Aussie yen, CAD yen, Euro yen, pound yen, Swiss yen, New Zealand yen, they've all been higher than those intervention levels. The dollar has not. So there's no number that has to be they're going to stay and they're going to protect this level. It's not true, right? So, like I said, the interventions that we've seen have been on rate of change. Even right here, when they intervened, they started intervening when the market did what? This low to this high was around 10%. That is a bit of a chin scratcher. Why? Because if we have a 9 to 10% move in a short amount of time, that is perhaps where we're starting to look at a little bit more intervention potential, which is not the best way to be trading forex, right? That's the most disruptive thing ever, to have a central bank come in and disrupt prices and see flash crashes up or down, you know? So I will say this: I think we should pay attention to this low. And if we get up 9 to 10%, that puts us around 165. Okay. If we start from this most recent uptick that's been pushing from around 155, we're looking somewhere between 165 and 170 if we're going to see another intervention level. Okay. And, look, I know some pretty smart people that are starting to take some trades. I mean, I'm taking a small chunk, a small tranche in the FXY. I understand that I might withstand another drawdown. Maybe the FXY drops another 5 or 10%. If that's the case, it's okay. Gets a little bit cheaper. I've got ways to trade it. I'm probably going out to 2026 if I'm trading options. I'm probably just going to buy and hold and dollar cost average in. Um, it's not going to be an arm and a leg, but it's going to be something that I think having 2 to 3%, possibly something I could turn into a full 2 to 3 to 4% move for my portfolio. I'm going to try to make as much money as I can if and when it's time. The Japanese yen is certainly not a currency pair that we have to fight. It's not worth it. I'm not trading forex. I hate it. I keep saying it, but at some point traders might listen. You know, uh, I've made more money not trading the yen than I have by finding good trades. This yen trade, by the way, is really easy. Okay. Can everybody see this outer trend line? We had our big November correction, or our big October, November correction in 2022. So we poked out here the highs and we had a nice, kind of 50% pullback. But then from there, it's been all carry trade. So what I think this might do is, let's say that 165, 170 is a reasonable rate of change of another 9 to 10% depreciation. Well, if that is the case, okay, fine. Don't fight the yen. Stay with the bullish side right now. But what would be a really simple trade would be if we stretch far enough away and start to turn the corner and confirm, then we come right back to these levels. So if we were up to 165, 170, we pulled back to 152, there's a lot of opportunity there. What makes this even more damaging is if we came in and took out this low, and put in some massive topping formation, and then we actually had a full-on reversal where we're taking out, major levels, and we have this big, big, big deleveraging. Now, this pattern that I'm drawing on the screen might not be until 2025. It might not be until, late 2025 into 2026. But the Japanese yen weaker is helping the Japanese economy. But there is a point where it's too weak. There's a point where, what's happening with certain currencies like that, it's almost unfair to have a currency get so weak. And it certainly, I mean, it doesn't help. I don't know. I mean, I will say this: if we in the U.S. had a dollar that over the last, let's say year, okay, over the last year, if our dollar has depreciated by 25%, I don't think you'd have a lot of people happy with that, right? When we see these big moves in the dollar, okay, what's this as a percentage? When we peaked out here in 2022, this dollar had a change of around 11 to 12% weaker, right? The dollar's been steady since that point, but we had a huge wave of weakness in 2022. Okay. This was timed pretty closely to also when the yen got stronger. So I still watch this level. I still think there's a broadening pattern. I think the best the dollar is going to do is going to be retesting these highs at 114. I would still love to see the dollar get up into this area here and then work its way down. Have a bigger sell trade. This pocket gets filled, great. And then we come back down, test these lows again, maybe break some fresh lows. We'd have another follow through trade from this high to low, lower high to lower low. Try to find some symmetry on this broadening pattern. Okay. If it's going to be a range, which makes sense, we have a high right here, we have lows right here. This broadening pattern might not be the trade, right? Maybe that's too much. But the dollar, is it going to get that much stronger all of a sudden? I don't know. I mean, the dollar could get stronger if the Fed doesn't cut, right? If the market gets surprised by the Fed and they don't cut, we'd see that happen, leading up to that September rate decision for FOMC. But if the Fed does not cut, the dollar gets stronger while other central banks are cutting rates, then we could see an actual run on the dollar for a bigger setup later to sell. So all this stuff is, pretty easy to read in the higher time frames. It's just a lot of noise and a lot of chop happening right now. In currencies, things are pretty slow. It's low volume, low volatility, and we've got to be prepared for that. We've got to be watching our levels, watching our technicals, and just making sure we're not caught off guard by some type of move. But there is a lot of noise. Okay, all right. Because it's opening bell right now, I'm going to get into my Schwab account. I'm going to see if I can do a quick roll on Chewy. I do have some naked puts out there as well for my Tasty Trade account. And I think I did like a 1750. Let that thing, I mean, it's a put, so I'm not like crushing it to the upside, but on my Schwab account, I do own the shares. Okay, I'm just going to get logged in here. ABR and Airbnb. All right, I'll take a look. All right, so we did the dollar. Let's go oil, gold, silver. Oil at 82. I remain bullish on oil for right now, even if there's a pullback coming. I think that we put in a really strong reversal here once we had this bit of a bear trap in June and we rip back to the upside. I think there's enough to kind of keep it steady. So I like this low to high. If we continue to push a little bit higher, that's oil. No big deal. Summer demand is pretty much in full swing. If we have a bit of a pullback, I think we're pretty well supported right here on 77.50. So I don't want to see the bears break below 77.50. And possibly the bulls just continue to drift higher. Okay, gold and silver. Let's go here. Okay. Let's go account balances, positions. There we go. Okay, this account is getting cleaned up real nice. August 2nd, 27.50. Can I roll this out? We're going to find out. I could roll it up to $29. That's going to cost me maybe nothing. If I roll it out towards the end of August, I could roll it up to $30, give myself $2.50 more in profit, but I'd have to roll it for a small debit of maybe, see the bid price $1, mid shows a credit. See if I can roll it out farther. November. September, I get a credit for that. Okay. Let me go back to Chewy for a second. So Chewy 28. I think I'd be getting a little greedy if I'm trying to roll it, way up here, but I will certainly try. If I went out to the end of the year, let's go October to January. I could roll this up to 30. 32.50 gives me profit. $35 gives me profit and a credit. 37.50. Not bad. I can get 90 cents credit. Roll my price up $10. I'm gonna try that. See if I can get 75 cents. That's not gonna work right now. Trade account. I'll try to get 50 to 60 cents on this if I can. Count. All right. Order status. See if we can get 70 cents. All right. So I just rolled this thing out for 70 cents. I increased my increase my profit potential by $10, which for the shares that I have is a couple $1,000, and also rolled it out to the end of the year. So if Chewy makes a big old rip, now my covered call, I just rolled this out, rolled up and out for 70 cents credit. I now have a 1/17/25 expiration, 37.50 covered call. Okay, so I'm pushing it up towards these highs in case this thing gets antsy and starts to rip. Now this could also be a trade where this carves out a low, we test this high. This could be a head and shoulders trade where we settle back in here and we consolidate for a while, and then you got to wait for Chewy to give us another kind of accumulation phase where the market just sits and waits. Okay, so all right, let's go back to gold and silver. We'll probably talk about this at the top of the hour with Nick and the team with A1 Trading. Gold at 23.26. I still like gold, pretty well supported. I'm looking at trades probably today in a gold futures market. I'll probably go out 45 to 60 days, try to put on some type of trade in gold where I really don't want to have any type of assignment price on the futures market or GLD for that matter. But 2200 would be my support zone. And see if I can keep it kind of maintained where this level holds nicely. If it does, easy trade. I don't see gold coming back necessarily to 2000, so I think we're just sideways, right? Little sideways. If it's supported, I could see gold ripping there. So coming back to 24.25, I wouldn't be surprised if we already have some measure moves on gold. Okay, if we have, let me go back even further here. If we go to symmetry, which is what I'm kind of looking at here, let's go to this trade, take this low to high swing. Okay, so the range we have measured, so we're looking for a move all the way up towards 24.75. If we take that symmetry, we're also pushing up towards about 2500. Let me see if I can just drag. Let me go to a higher time frame. I mean, this goes back into the 06 price for XAU. 1, 2, 3. Is this 1, 2, 3, 4, 5? Possible. Or we have a 1, 2, 3. 4 is now with a pause, and then 5 is still coming. So, I mean, either we have 1, 2, 3, 4, 5, and this is a correction that's on its way, but the trend continues. Or if you start from here, all this accumulation, 1, 2, 3, we're pausing now for 4, 5 still has to hit. I would make a bold than a forecast to say that I could see gold getting to 3,000. Doesn't mean I know the time of that, but I think that's reasonable with all the other stuff going on for the dollar, currencies in general, fiat system versus backing it with something else, having gold as a hedge, inflation plays, you name it. There's a pretty good case to maintain long gold exposure. And because of that, typical technical setup where gold and silver perform well together, I like silver as well. So I will be looking for some gold trades this morning. Silver, we're trading at 29.35. We still have not, made a nice bullish run. Obviously, I'm way more bullish if price gets above here and starts to rip back to highs. We've got this measured out to 35 and change. If we look at SLV, okay, I'm looking to take some assignment on SLV. I do want to own this. I will probably own this with maybe a collar position. So if I take assignment, which is going to be in July, I think July 19th are my expirations. If I take assignment on silver, I'm going to add a covered call and I'm going to buy a put. So I want to protect myself to the downside just in case, but I want to try to sell this thing, trying not to get in the way. But if I were to lose it at 32 and I own it at 27, turn it for $5 a share, that's not too bad just to continue to make some profits. Resistance levels here, measured move up to 32 and change, finishing move all the way up here towards $44 to $45. Now, again, destination 44.54, but do we get here first? Come back, get here again, come back. I mean, is this silver? If it is, obviously I'm going to try to take profit at these highs. If silver is a move all the way up here and then it consolidates and finishes here, well, I might end up sacrificing and forfeiting some profits if the market just goes higher and I'm getting called away at $32, $33. You know, I can always get back in, but nevertheless, I mean, I like this area to be buying, accumulating, taking some positions, trading options, silver futures, trading credit spreads, whatever you want to trade, but looking to stay and maintain a bullish outlook. Right? Bitcoin 62. This is probably a better sign for the bulls to have at least a little bit of follow through. So we came down and sniffed that 58,000 level, 58.5. I've been saying that 60,000 to 56,000 is a really key level for those bulls to step in and not mess it up. If we have a bear trap, that would be right here. Bear trap could be a thing, right? Bears come back and poke these levels, but those bulls better show up. If they do, they're going to rip up here, and then we'll see if that momentum turns to get us back to the all-time highs at 70, 73, and 74,000. So that would be I think that's a pretty solid plan on Bitcoin, but it's really critical that those bears are going to have a tough time breaking. I could see the bears tapping, testing, maybe faking out, but those bulls have to snap this thing back in order to kind of save this bull trend, in my opinion. Otherwise, it gets a lot dicier out there if we start to break below 56,000. Ethereum, same type of thing. I could see, this sideways, some indecision. It looks like we have an ascending wedge, but this might just be also indecision. Ascending wedge should be this. We're up, we have equal highs and higher lows, and that's an ascending wedge, and we look for a breakout. This is slightly different with indecision, but same type of setup where this support should hold. If we have correction into the trend line, perhaps this pocket zone is a nice demand area where the market jumps up, or we have a correction that comes all the way back down here into the same lows. That would be your potential bear trap where the bears, poke down here, test these lows, and then the bulls rip it back up, and off we go to retest highs. So if the bulls are going to defend, they better defend Ethereum around 2750 to 3000. The bulls better defend Bitcoin around 55, 56K. Dark pools, I keep hearing, and options trading moving. I mean, unless you're in them, it's just something you got to deal with. Dark pools are basically liquidity pockets that are all institutional. There's a lot of, realistically, there's a lot of collusion, right? I mean, the best way to kind of participate with those dark pools would be watching your massive levels of open interest and looking at your gamma levels. That's probably the best way to have an idea of where those magnets are in the market. Those are dark pool magnets. So I think the best way for a retail trader to find stuff like that is if you have ridiculous levels of open interest, certain expiration points, round number points, and also if you have some gamma levels. In my options platform with dynamic trends, same thing. Like last week, I was long the SPY at 548, right? Price is trading at 550, 545, 545, 545. The gamma levels I saw all week were 548, 548, 548. So I took a long call. And on Friday, when we had that move from 545 up to 550, call it a dark pool. I don't know. I don't know. Right? Maybe it was, maybe it wasn't, but it was a gamma level and it was clear as day for me all week. So that's my best insight to have an idea of where, the market actually moves because those open interest levels and gamma levels are hit and influencing the market price action wise. So just a quick thought on that. Okay. Let me see. We did dollar, oil, gold, silver. We did some Bitcoin currency wise. Let's take a look at the currency strength chart from the weekend. Euro's coming back a little bit. Swiss is weaker. This is probably music to my ears. Okay, Swiss weak, Japanese yen weak. Who cares? Everything else is up. So this should be helping my Swiss positions from last week. I did post a video on that. We did a class on it with my portfolio builder on Friday. So we did a live class right here. Posted a video. Posted some updates. All my positions for buy stops, buy limits. Aussie Swiss, CAD Swiss. Okay, Telegram. Getting flaky on me. What the heck? All right, let that download. Anyway, that was my Telegram update from Friday. So we had a good class, added some positions, just revisiting the Swiss basket. So speaking of, Aussie Swiss, bought some at market in addition to having a pullback trader on the right-hand side of the trend line. I'm long Aussie Swiss. CAD Swiss, this is another spot too. I mean, we had a strong sell-off. I bought the CAD Swiss in here. I bought it at market. I've got some breakout trades above here. I'm watching closely. If this is a right shoulder, okay, this is our low, this is our high. This looks like a neckline, left shoulder, head to neckline. If this is establishing the right shoulder, we can look for a pattern in here, but we also might see this market just might start to rip. If we break this neckline, I'm long CAD Swiss. 71 to 72 is my target. If this is going to happen, now's a pretty good time to do it, right? We've seen 2 cuts by the Swiss National Bank. The euro seems to be getting a little bit stronger. A little bit strong. I mean, look, you've got a gap. You got a gap on the euro. But I will say this: don't be surprised if this gap gets filled. Our stop loss on the euro dollar short is up here. So if we, mess around a little bit this first couple of days here, do we have a gap fill? I hope we actually retest the lows. But we've got some election drama going on in the European Union. There's French elections. There's parliamentary elections coming out this week. So I don't know. It's going to be, I don't know. It's just a trade, but I just wonder if the largest swing that we had on the euro dollar was this high to this low, right? ECB cut rates. We're pulling back right around this structure. Or if this is high to low, we're pulling back to that 50618 zone. If there's a follow through there, I could see the euro dollar getting back to 105. If we actually have a push coming, I could see the euro dollar coming back and actually getting back to parity or lower. I don't know. I mean, you got to wonder, like, the euro is heavily weighted on the dollar. How strong does the dollar end up getting? We'll find out. It's going to be a weird correlation to see super strong dollar and also super strong stock market. But anything is possible. Could be one of those weird years where dollar's up and the markets are still up. Okay. So back to the stock market really quickly. We'll take a small break. We'll be back at the top of the hour for the Pulver Report to kick off with a round 2. I'll be joined with Nick and the team at A1 Trading, and we'll kick around the markets. I really am just going to focus this week on probably gold, probably silver, probably cleaning up the portfolio. I like this overall. I mean, this to me is extremely simple to manage. I don't have a ton of positions here in this portfolio. I can probably start looking to roll this as well. Option wise, if I get rid of Alcoa, this is out to July. Chewy out. I mean, this is probably to the point now where I can make my ACATS transfer because I can't have open options within 3 weeks. So I think once my July 19th expires here, I'll just chill on this account and get this rolled in. So I can add about $80,000 in buying power to my Tasty account, which would be nice. And it's also all in one place with my other managed accounts. That'll make my life a lot easier. And then I can passively manage my IRA. I mean, it's not passive. It's active enough, but I only have about 5 core positions in my IRA that I'm focused on. So right now, I'm up around $9,000 in Bitcoin positions. I'm up around about $3,000 in Amazon and about $1,000 in Baidu, which was up a ton more than that. But yeah, those China stocks have given back quite a bit. So, anywho, let's see. Anything else to chat about today? We'll revisit all this stuff in the next 12 minutes. I'm going to log into Tasty and just do some checking. I'm probably going to trade gold, silver today, and probably look to get some positions established for a both directional trade. I want to see what this one costs. If I went out, I did just a lot of back testing the last couple of weeks on some of my core strategies. If I went out 30 days, give this market time to move, see it, as long as we don't overpay for it, right? So essentially I'd be, it'd be like a 50, it'd be probably a 45 to 50 delta if I buy that, and then I'm going to sell against it probably a 10 to 15. So I'm trying to give the market room to run. I'm trying to give the market some directional plays. The SPY on a weekly basis still averages about $11 and change, almost $12 a week. You can see here that for the last couple of weeks, we have had the ability to tap those levels. We've had some indecision, we've had some wicks, but having look at this 1, 2 indecision weeks, right? this high to low, this high to low. Check those levels. That is a what is that price? 542.50 to a 550. We're talking about a $7.50 range right now. That if and when it breaks, if we have a 750 range and it breaks for $7.50, one way or the other, we're looking for some direction. So if we break 750 down, I'm pretty much trading right in the middle. So if I take this little, $3 move plus a $7 move, maybe I've got a $10 move with some time left in the trade. Okay. But when do we find out? Maybe it's this month. Maybe it's in the next couple of weeks. Maybe it's this week with FOMC minutes on Wednesday and non-farm on Friday, enough to get the markets to move, even though nobody's really watching the low volume markets with low implied volatility, low open interest. We could have kind of a surprise move. And I'm not saying it has to be bearish, right? We could have a surprise move where the market wants to go higher again. Who knows? So, I mean, I would probably trade both directions just to be on the safe side and go out. If right now we can go out to August, pay for about 30 days. That's the mechanics of my trade. So as long as I'm not overpaying for the option, we'll take a look at that with equities on demand today. Okay. So here's the deal. Let's take a little 10-minute break. I'll come back for the Pulver Report at 10 o'clock. I'll stream on my channel. I'll join Nick and the team at A1 Trading, and Equities on Demand will have a session today at 11:15. All right. If you're here on my channel, I do appreciate you tuning in live. If you're watching the recording or you're watching it live, just take 1 second, hit that thumbs up button for me. That goes a long ways. Give me, if we have 200 viewers, 300 viewers, we get, 99% of those likes. Great. That helps a lot. Where then when I go live, it helps that little search engine bar that, you go on YouTube, you can see that we're live trading. And, anyone looking for trading, education, and we're looking for trading, live investing, stuff like that, will pop up in some of those feeds, which will be nice. Some ads and followers. TLT, I'm still long TLT. So last week was not great, right? TLT was down. I'm still long through 2026. I'm not trying to time this, to the month. I'm going out and saying, look, if we're going to have some type of bond play, more than likely we're going to see it change in yields, right? The 10-year versus the 2-year. The 2 years trading at 4.77. The 10 years trading at 4.43. Okay, we're still it's about a 0.3% inversion. So you got to wonder, and this is what the argument is: are we going to see a steepening before we start to see that this is a inversion, or I should say lack of inversion? We need to get right side up, but you wonder if it steepens on the longer end or the shorter end. So does the 2-year get steeper or does the 10-year get steeper? I don't know. But the TLT is going to be the reaction to bonds. So bonds, TLT is your 20-year. So when does this get more attractive? When yields drop, right? So if you're looking at the 20-year, here's the 20-year bond yield. We're sitting at 4.7%. I mean, this is kind of crazy. If you had the 20-year window to say, look, right now I could lock in a 20-year bond at 4.7. This is the yield. Okay, what we'd have to see as this yield goes down, that TLT goes up, right? I don't trade bonds when it comes to all the technicals here, but it would make some sense if I see this. Oops, that's not working very well. If we just watch that kind of structure, something like that, right? So this can float, this might work its way just choppily, back up to some highs. If yields are going higher, guess what happens to the bond? US 20Y, this symbol for the yield, goes up, then the TLT bond price goes down. Okay. If this starts to make an aggressive move down, then TLT goes up. So that's really what you're watching. If you want to see TLT go up, you got to see this yield drop. So whether it's the 2-year, the 3-month, the 10-year, whatever it is, those yields have to be going down for those bond prices to go up. Inversely related. Okay. All right, everybody. I'll see you at the top of the hour. Come back and join me in 5 minutes. Just come right back to the channel, youtube.com/Chris Pulver. Okay. See you in a little bit. Thanks. Bye.